In January 2026, just 4 months ago, gold hit $5,595 per ounce, the highest price in recorded human history, higher than the peak of the 2008 financial crash, higher than during COVID, higher than during the worst inflation crisis of the 1970s, nearly 3 times higher than just 5 years ago. Gold has always risen during uncertainty. That part is normal. What is not normal is that this time, gold is rising even when the rules say it shouldn't, even with high interest rates, even with a relatively strong dollar. The answer starts in a decision made in February 2022 that most people remember for completely different reasons, and once you see the connection, you cannot unsee it. Welcome to Strategic Assets. Consider 2 scenarios. Scenario 1. A country holds $300 billion in reserves, sitting in accounts at foreign banks, invested in government bonds, managed through the global financial system, earning interest, liquid, accessible at any moment. Scenario 2. A country holds $300 billion in gold, stored in vaults on its own soil, earning nothing, heavy, immovable. For decades, Scenario 1 was considered smarter, more practical, better returns. Every major financial institution in the world recommended it. The IMF recommended it. The World Bank recommended it. Western universities taught it. But gold has one property that no financial model ever fully priced in. Every asset in Scenario 1 exists inside a system, and systems have administrators. Administrators have power, and that power can be used against you. Gold stored in your own vault answers to nobody. No government, no sanction, no executive order, no phone call between allies at midnight. It requires physical access, and if you have it, they don't. This is not a new idea. Gold has worked this way for 5,000 years. Then in a single weekend in February 2022, Scenario 1 disappeared. $300 billion, gone, frozen, inaccessible, with a series of phone calls between Washington, Brussels, and London. Scenario 2, untouchable. To understand exactly what happened that weekend and why it permanently changed how governments think about money, we need to go there. February 24th, 2022. Russia invades Ukraine. The world knows what happened next in military terms, but what happened in financial terms in the 96 hours that followed is the part that changed everything. 4 days after the invasion, the United States, the European Union, the United Kingdom, Canada, and Japan made a coordinated decision that had never been made before in modern financial history. They froze the Russian central bank's foreign exchange reserves, all of them, simultaneously, overnight. $300 billion, gone. To understand the scale of what that means, Russia had spent years building those reserves. To protect itself against economic shocks, that money was supposed to be Russia's financial armor, its emergency fund, its guarantee of sovereignty, and it vanished in a weekend. Not all of Russia's reserves were frozen. The funds held in Chinese yuan, safe. The gold stored in Russian vaults on Russian soil, completely untouchable. The one asset that could not be frozen was the one that answered to nobody. Now, put yourself in the position of the finance minister of Brazil, or India, or Saudi Arabia, or Turkey. You just watched the world's largest nuclear power have $300 billion rendered useless in 96 hours. You look at your own reserves, and you ask one question: how much of my country's wealth is sitting in someone else's system, right now? If this level of analysis brings you value, join the strategy by subscribing to the channel. We decode the global markets using visual economics that the mainstream media often ignores. Let's get back to the breakdown. So what did those finance ministers do? They started buying gold, at a scale the world had never seen before. The numbers come directly from the World Gold Council. Central banks bought 1,136 tons of gold, the highest level since 1950. Then 2023, 1,037 tons. Then 2024, 1,045 tons. 3 consecutive years above 1,000 tons. Before February 2022, central banks averaged 473 tons per year. After, they nearly doubled that rate. And in 2026, they are still buying. But look at who is buying. Poland, a NATO member, added 102 tons throughout 2025 and has continued into 2026, now holding over 580 tons, more gold than the entire European Central Bank. India flew 100 tons of gold home from the Bank of England vault in London under complete secrecy, using specialized aircraft and detailed security protocols. The Czech Republic has been buying consistently for over 2.5 years without a single month of stopping. Singapore, Ghana, Cambodia, Brazil. These are not Russia's allies. These are countries from every continent, every political alignment, all reaching the same conclusion at the same time. But central bank buying is not the only reason gold is at $4,400 today. There are others, and together they explain everything. The weakening dollar. According to Morgan Stanley, the dollar fell 11% in just the first half of 2025, the biggest single decline since 1973. More than 50 years. That number matters enormously because gold is priced in dollars. When the dollar weakens, gold automatically becomes cheaper for every buyer outside the United States. More buyers, more demand, higher price. It is a direct relationship. And in 2026, Morgan Stanley projects the dollar could fall another 10% before year end. More weakness coming, more gold demand coming with it. The second reason why gold is at this price is that gold is no longer following its own rules. Gold falls when interest rates are high. When bonds pay strong returns, why hold gold that earns nothing? That rule held for generations, accepted by every analyst, taught in every economics course. But through 2025 and into 2026, gold rose to all-time highs while interest rates remained elevated. The rule broke, completely, publicly. When an asset stops following the laws that governed it for a century, that is not a market glitch. That is a signal. It means the demand driving gold is so structural, so fundamental, that normal market forces can no longer suppress it. Third reason, geopolitical tension, everywhere, simultaneously. Ukraine, the Middle East, Taiwan, trade wars between the world's largest economies. And in 2026, not one of those conflicts has found resolution. And finally, regular people. Gold ETFs, funds that allow anyone to buy gold with a single click. Recorded inflows that broke every previous record. Individual investors watching their savings lose purchasing power, all moving toward gold. At the same time, 5 reasons, all arriving simultaneously. That is why gold is in the range of 4,000 today. And the question you now need to answer, is this over or is this just the beginning? So the question you came here to answer is still open. Gold is in the range of 4,000 today. It hit $5,595 in January. It pulled back. And now every major financial institution on earth is publishing forecasts for where it goes next. Here is what the smartest money in the world is saying. JP Morgan, the largest bank in the United States, raised its gold target to $6,300 per ounce by end of 2026. Deutsche Bank, $6,000 by end of 2026. UBS, $5,900 base case. Wells Fargo, $6,100 to $6,300. Goldman Sachs, the most conservative of the major banks, still forecasts $5,400. The most conservative major bank forecast, the pessimistic case, still sees gold rising another 22% from where it sits today. Every single one of these banks has cited the exact same 3 drivers for why gold goes higher from here. Central bank buying continuing, the dollar weakening further, and geopolitical tension showing no signs of resolution. The same 5 reasons that got gold to $4,400 are the same reasons every major institution believes it goes higher. And there is one more detail. Now, does this mean gold only goes up from here? No. Gold pulled back 10% in March 2026. Volatility is real. Pullbacks happen. Anyone telling you gold only goes in one direction is not giving you intelligence. They are giving you a sales pitch. What the data tells you is this: the structural forces driving gold, central bank buying, dollar weakness, geopolitical tension, investor demand, none of them have reversed. Every major bank that commented on the March pullback called it a buying opportunity, not a turning point. The institutions that manage trillions of dollars, the ones with the most information, the most analysts, are all pointing in the same direction, and that direction is not down.